Good afternoon, everyone. Thanks for joining today's strategy and stock pick for the fourth quarter of 2023. Glad to be engaging with our PhillipCapital investors for the first time. We will be starting off today's session with the macro before moving on to the Malaysian strategy. Okay. IMF World Bank continue to remain cautious on the global growth, which has seen multiple times of downgrade this year. Some of the major powerhouse, as you can see, such as US and China, for instance, has also suffered the same fate of downgrade. Further dollar appreciation is also partly affected, driving the weaker growth ahead, as well as the credit condition as Feds continue to hike rates. Global inflation across most of the regions have shown a good sign. Inflation has generally been trending downwards in most of the major economies. But that being said, CPI remains sticky on a high level. And of course, with the recent strengthening in commodity price, such as the global oil and natural gas prices, we believe that this may potentially pose some upside risk to the global inflation outlook in the coming months ahead. So definitely something that we are watching out for. In terms of the US Fed funds rate expectation continue to be revised upwards, we believe that there could be one more rate hike for this year, possibly peaking in the first half of next year, and a rate cut as early as second half of 2024. Closer back home, as you can see, Malaysian interest rate differential continue to widen with the aggressive Fed funds rate hike. Just to recap, US hike about 525 basis point versus the 125 basis point by BNM. And with the market expectation of US continue to be hiking the rates, we believe that the interest rate differential will continue to widen in the short term. As such, possibly further strengthening in terms of the US dollar against the ringgit. So basically this graph actually shows the same thing. In terms of the Malaysian inflation, relatively stable, largely due to the targeted fuel subsidy. We believe that Bank Negara is done hiking the policy rates for now. Our base case is we do not expect any further rate hike. But that being said, depending on the targeted fuel subsidy mechanism that was mentioned in the 12th MP midterm review, if the new mechanism should cause a spike in terms of the inflation, we do see a possibility of BNM actually hiking the rates again. But overall, to sum up the macro part, we expect ringgit to continue to depreciate, possibly in the region of about 460, 480 level. Malaysian inflation likely to stay below the 3%. Malaysian GDP growth will likely look in the region of about 3.6% for this year, and possibly about 4.4% for next year. And of course, like I mentioned earlier, Bank Negara to maintain the OPR. So moving on to the strategy, this is a quick summary of what we are planning to run through for the Malaysia market strategy. Overall, to set the tone before we dive deeper, overall, we are still expecting US recession to happen sometime near mid of next year, despite the earlier market expectation that recession should already have occurred this year. So in our view, it's delayed, but definitely shouldn't be ruled out. And generally, our local market direction tend to follow the trend of the US, meaning S&P pullback will naturally be felt for the local market as well. But we do think that Malaysia market tends to outperform during the bad global market, which I will explain in more details later on. So a recap of the 9 months 2023, US, especially NASDAQ, has done remarkably well in the second quarter. Japan, next on the list, has been attracting foreign investors on stronger corporate earnings. Economy has also been showing sign of recovery. Taiwan, Korea, India, which I will go into further details later on in my later slides, are also among some of the market that has performed well. But that being said, if we were to move down the list, Malaysia is again among those that underperform, with KLCI actually down roughly about 5% year to date, despite the gains in the third quarter, helping to actually narrow the losses. Okay, so basically, this chart here just shows you among the big caps that has done well, and the sector in the past few months. Oh, okay, right. I believe that some of you is having trouble seeing the slides. Give me a quick moment. Okay, we are back. Apologies for the small technical glitch. As I mentioned, this chart shows you among the big caps that has done well and the sector. In the past few months, we all saw many property stock that have done well, construction sector as well. And in terms of the big cap CI stocks, in line with the 5% market decline, as you can see at the bottom part of the slides, most are actually in the negative territory, with the exception of just 4 CI components, Celcom DG, Maxis, Tenaga, and Maybank, which actually posted the marginal gains. And this is basically just a recap. Some of the key indicators: oil price is still trading around the mid-80s level, falling from the mid-90s, but nevertheless still a good level. OPR, as mentioned earlier, hiked by about 125 basis points year to date, as well as the weakening in terms of the ringgit, which should garner some lookout. And this is basically a page which I intend to spend a little bit more time on. Basically, the table on the left shows the foreign equity fund flow of the Asia 6 market, as well as Malaysia. If you focus on the column highlighted in blue, Asia 6 has attracted close to about 14 billion of US dollar of net inflow, with the biggest inflow entering India and Korea. And if you recall, in the early part of my presentation, those two regions has also posted a good returns. Similar to NASDAQ, we believe that it has been driven by the AI excitement. Thailand saw the biggest outflow, close to about 5 billion US dollar, and also the worst performing market in Southeast Asia due to the political uncertainty over there. But closer back home for Malaysia, we saw about 2 billion ringgit of about net outflow, close to about $500 million US, which is again close to about half of our last year inflow. I would say that this is nothing new. Over the past 10 years, as you can see at the bottom right-hand chart, we saw about 7 or 8 years of a net outflow. Foreign flow and KLCI performance tend to go hand in hand. Ringgit and corporate earnings growth actually play a very important role. Both actually need to be a lot stronger before we may see things reversing. So despite the fact that foreign shareholding is at its historical low, we believe that it's too early to call the bottom, as this hinges on the both reasons which I mentioned earlier on. And going into fourth quarter 2023 outlook, there are a few key things to watch out for. As I mentioned, US recession is delayed, but definitely not dismissed. US employment is still strong, but has seen the unemployment rate slowly creeping up. Fed funds rate is at its multi-year high and likely to be pointing higher. Inflation has come off, but seen an uptick of late. And if you look in terms of the US savings, I think that basically savings is running low. And on that note, some of the tailwinds that we see is student, for instance, has already started paying off their student loan since, in fact, this month, and social spending is expected to decline next year. So some of the macro headwinds that we see, but the saving grace that I would like to note is that US market is generally less speculative now. For instance, margin trade has been on the reduction. Okay, so again on that note, I would say that global market valuation is by no means cheap. Most of the market, S&P, Nasdaq, has come off from its peak since the strong rally which started early part of the year. But even with the recent correction, both are actually trading close to a historical mean. And what's driving the US market has always been a handful of the tech stocks. But something that should be on everyone's mind is the chart at the bottom. So what the bottom chart is basically trying to say is that yield curve inversion is actually a precursor of an upcoming recession. So as you can see here, it takes average about a year from the time that yield is inverted to a recession. And yield has been inverted since last year, July. So admittedly, it's overdue. And with this in mind, investor may turn risk off ahead of the recession expectation. And if you look in terms of some of the market intelligence that we are seeing, the probability of a US recession has risen to about 60% currently. So how does all this boils down to the local market? We believe that the local market will stand out in terms of its defensiveness. On the graph on the upper right-hand corner is actually the relationship between the S&P and the KLCI during a recession. And historically, our market tend to outperform during a period of a global pullback. And this time around, we believe that it will likely to be the same case. Firstly, the benchmark KLCI has already declined by about 5% year to date. And supported by a healthy economic environment, Malaysia GDP growth is still expected to grow by about 3.6 to about 4.4% next year, landing a support. So thirdly is the valuation for our local market. It's already trading at its -1 standard deviation below its mean. So while we are still expecting a volatility, we believe that based on all these reasons combined, KLCI will relatively outperform. And if you recall last week, when US actually fell by about 1-2% overnight, we did not fall as much. So downside will be a lot less in our view. Okay, so the small cap index has outperformed the CI this year. As you can see, small cap is up close to about 10%, whereas the local market is down by about 3%. This is again, in our view, due to the cheaper valuation. Earnings profile has also been a lot stronger as compared to the large cap. And moving into the fourth quarter, that's how we want to position as well, in the sense that we do see better opportunities in the small mid-cap space to actually generate some alpha. And this is just something, again, to watch out for, the upcoming KLCI rebalancing. Dialog and Westport at the risk of exclusion, possibly replaced by YTL as well as YTL Power. And this is basically just a summary of our coverage as well as our topics. In terms of the sector and stock positioning, we will be highlighting a few of the names that we like. So generally, we are overweight on the EMS, construction, oil and gas for the fourth quarter, and neutral on property. So from here on, I'll be touching more of a sector specific. On the EMS, it's largely on the trade tension and the diversion theme that has seen Malaysia actually benefiting very strongly from this, as global MNCs actually uproot their supply chain and manufacturing hub and moving over here. And in this space, we actually prefer the industrial over the consumer names, and few reasons, right? The industrial players are more well positioned in the secular trends, the AI, data centers, the 5G optical module, transceiver, etc. And on the flip side, in the consumer space, where global end demand is still relatively fluid and uncertain to a certain extent, with the likelihood of a possible US recession happening next year. So to play the EMS sector, we have actually a buy call on NationGate, target price of 180. Basically, this company have exposure in the 5G optical module space as well as data servers. If you look in terms of the 2024 earnings growth, is expected to see a strong comeback on demand recovery, and we do think that the recent pullback actually present a very good opportunity for investors to actually accumulate on this structural growth theme. And secondly, what we also like is the oil and gas sector. Few reasons here. Oil price should sustain and trend higher on better global supply demand dynamics. Petronas is overall expected to roll out more work orders and tenders due to the underinvestment and maintenance from prior years. Also, expectation of a stronger upcoming third quarter results as well as 2024 earning visibility. I think in terms of the commodity prices, with Brent oil price trading in the mid 80s level, we do believe that it's actually looking positive. So that will actually benefit the national oil company and the oil majors to actually resume activities as well. So to actually play the sector year in, year out, we will always take guidance from the Petronas Activity Outlook, which tend to release every end of the year in December. And the 5 beneficiaries include hookah commissioning, your maintenance, construction, and modification space, the jackup players, the hydraulic workover units, offshore fabrication, as well as the pipe suppliers and coaters. And to play the oil and gas space, we highlight Dayang as one of the prime beneficiary to benefit from the higher oil and gas activities. We have a buy call on the stock with a target price of 230. Okay, and basically that sums up my part on the macro, the strategy, as well as the sector. I will take a pause here and pass over to my colleague Kejun, who will be bringing us through the construction and the property sector. Over to you, Kejun. Thank you.
Hi, good afternoon, everyone. I'll be taking over to share the screen. Jerry, can you stop sharing from your side? And then I'll share from my side. Done. I'll take over and share the screen from my side so that I can have better control over it. Okay, so everyone can see my slide? I believe so, should be, right? Can you give me a mic? Okay, sure. Okay, so I'll take over and talk about construction and property as well. I believe some of the audience who have been joining us in the past 2 quarters, I mean, you should be quite tired of my face, but this time we have our new head of research to take over on some of the macro and also some of the other sectors. So, okay, without further ado, I'll go into construction. So we have overweight rating on construction sector as a whole. And then basically with that, we are basically expecting a pipeline of mega projects to be rolled out in the coming months. And we are positive on the higher development expenditure that was announced in the 12th MP midterm review. And that basically gives the government, it basically indicates that the government is committed to allocate at least 90 billion per annum for development expenditure from 2023 to 2025. And then with that, we are expecting mega infrastructure projects such as MRT3 and also Penang RT to be expedited, and then possibly with contractors to be appointed in the coming months. And we are expecting better clarity on mega infrastructure projects during the tabling of 2024, budget 2024 this Friday as well. And then recently, there's also some discussions on the potential revival of HSR, which is the KL to Singapore high-speed rail. But I believe everything is still in a very preliminary stage, and from my side, I'm not expecting material development on this project in the next 2 years because we still have plenty of mega infrastructures that we have to basically expedite before going on to that. And I have to keep in mind that project will be funded privately, so there should be more more details that need to be ironed out in terms of the funding structure and how both government needs to collaborate on that. So yeah, with all this, we are expecting beneficiary with we are expecting the beneficiary of this kind of mega projects throughout to be contractors with railroad infrastructure track record, and from our coverage it will be Gamoda and Sunway Construction. And then a quick glance at our coverage PE. So some of our coverage have seen some run up in terms of share price, and is currently valued at around the mean PE of 13 over times. But then with the rollout of all these mega infrastructure projects, we believe all these contractors possibly might go to might be valued at +1 valuation, which is around 16 times PE for PE. And then next slide. Okay, another theme for the construction sector would be the growing data center investments in Malaysia as well. So Johor is now becoming an increasing attractive location for foreign investments to set up data centers. And this is partly driven by the capacity limitations in Singapore data centers, which led to a spillover of demand into Johor thanks to its close proximity. And then what's so special about data center jobs for contractors? So typically data center contracts typically come with a relatively short turnaround periods, which is about 2 years only, as compared to usual infrastructure projects of contractors that takes about 5 to 8 years. And then for building contracts, it would take around 3 to 4 years. And this relatively short turnaround period of 2 years should give better ROI for all these contractors. And then in terms of margins, it's also that the contracts typically come with healthier, better margins for the contractors because it involves certain aspect of value engineering in the design and building part. And then with that, we are expecting the aggregated capacity of committed and early stage planned data centers in Malaysia to essentially double the existing live and under construction capacity of data centers in Malaysia as of 2022. And then basically our picks are Gamuda and Summit Construction on this team. And then with that, I'll a quick go through on our coverage as a whole. So basically, we reiterate our overweight call on construction sector as we anticipate, our coverage to benefit from the rollout of mega infrastructure projects, the influx of data center investments, and also consistent contracts from the resilient property market. And then in terms of top sectors buy will be Gamuda and Kerjaya Prospect, given the strong position they hold in the respective construction subsectors of infrastructure and also building construction. And in terms of valuation, Gamuda and Kerjaya Prospect are also trading at below sector mean forward PE, as you can see from the table. The forward core PE multiple for our coverage is actually at 11 times, but for Kerjaya and Gamuda it's only at 8 and 10 times. And then key risk includes delay in rollout of infrastructure projects and higher building material costs. Now I'll go through it a little bit more in details on our top sector buys. So basically, we like Gamudas for its regional exposure for both construction and property, where basically Gamuda is well positioned to have a slice of cake in both MRT3 and also Penang RT that we are expecting to be rolled out in the coming months. And that essentially should provide quite a sizable amount of order book replenishment for Gamuda. And then besides that, the group is also not fully reliant on Malaysia itself only. They are actively seeking for infrastructure jobs in the international markets such as Australia, Taiwan, and Singapore. And basically on the property development side as well, the local and international townships are maturing and providing consistent sales to the group as well, while the group is also actively acquiring quick turnaround projects in several international markets, and the recent one will be the one in Vietnam. And then we believe Gamuda's current valuation remains attractive at about 13 times only, while the TP that we have is pegged to 16 times. And then we believe there will be benefit from the upcoming infrastructure projects rollout. And then next, we'll move on to Kerjaya Prospect. So basically, we like Kerjaya Prospect for its consistency in delivering above average PAT margin of 10 to 13% as compared to industry average of 5 to 8% only. And then in terms, and we like its track record in consistently securing high-rise construction jobs from reputable clients such as Gamuda and UAM Sunrise. And besides that, we believe the value proposition for Kerjaya Prospects also come from its consistent contract flows from E&O, who is currently developing a Reclaim Island master plan. Basically, it's called Andaman Island, with an estimated GDV of 20 billion that will be developed in the next 15 years. And that essentially will provide quite the stable flows in terms of infrastructure and the reclamation contracts, in terms of the building contracts on that island. And then that should be quite sizable, and it will continue to supply Kerjaya's order book in the coming years. And then besides that, it's a joint venture that is 70-30 joint venture with Samsung also opens up opportunities for the group to venture into design and build contract for advanced production facilities. And for example, the Texas Instrument Factory in Malacca. This joint venture, basically they go into joint venture with Samsung so that they can essentially learn some of the higher advanced technology that Samsung uses, so that they can eventually get more of this kind of advanced production facilities as a joint venture, or even take it on from themselves. And then in terms of Kerjaya's current valuation, it remains attractive below its mean of 12 times forward PE. And then now we'll move on to property sector. So I'll quickly take I'll take a quick glance at the property market momentum as a whole. So basically, property market overall momentum remained resilient in the first half. Value of transactions was marginally higher, 1.1% year on year. And then residential overhang reduced by 23% year on year. And that partly come from the reduce in housing supply in the second half of last year. And in terms of the Malaysian house price index, we noticed that it's normalizing from the sharp recovery seen in the previous quarters. If you look at the graph below, in terms of the second quarter, you can see that there's a slight dip, but we don't see it as a worrying sign. We just see it as a normalizing from the sharp recovery that we have seen in the previous quarters due to all the pent-up demand and also the sharp recovery. We actually see this slight dip or normalizing to be a good sign. Essentially, it will keep the property to be affordable for population. And then this is the charts that show previously what I have shared in terms of overall value of property transactions. It remained around there. We don't see that sharp increase anymore. And then in terms of residential overhang, it reduced quite significantly, where essentially it reduced by 22.9% year on year. And then in terms for our developers under our coverage, they have already locked in quite a good portion of unbuilt sales. On average, it's about 1.5 times the recent financial year property development revenue. And this kind of unbuilt sales will essentially provide revenue visibility for our coverage in the next 3 to 4 years. And then in terms of the normalizing property market momentum, majority of the developers are actually conservative in terms of planned launches for next year. So they are more or less planning to launch the same amount of launches next year. And that should it's more like the property market trying to find the equilibrium. And then I believe some of you might be interested in the property developers with land bank in Johor. I've seen a quite spike in buying interest due to the factors such as Johor RTS, the potential HSR revival, and also the proposed Johor Singapore Economic Zone that have led to some speculations on some property counters that have land bank in Johor. But then for our coverage, Legenda will be having 2 upcoming developments in Johor with a total estimated GDV of 4.9 billion. And we believe these 2 upcoming developments in Johor, whether there will be potential revival of HSR or not, we believe these 2 projects will likely to have strong demand as well, because Legenda essentially is providing affordable housing, and with the kind of influx of industrial parks into Johor, that will essentially require certain affordable housing such as the products that Legenda is providing. So we believe Legenda's products in Johor is likely to be have strong demand even without this potential HSR revival and also the proposed Johor Singapore Economic Zone. But overall, we have a neutral call on property sector due to the lack of catalysts. And then sector valuation remains undemanding, trading at about 5 times forward PE. And then for dividend yields of Legenda and Skybird, they are attractive at 4 to 5%. And then, yep, that's about the presentation from our side.